May delivered strong market returns as the S&P 500 erased its year-to-date losses despite significant fiscal and economic headwinds. The month featured a historic U.S. credit rating downgrade, advancing trade negotiations, and mixed economic indicators that created both challenges and opportunities for investors. Consumer sentiment remained subdued even as corporate earnings showed strength and inflation continued to moderate. Treasury markets experienced volatility amid federal spending debates, yet equity markets demonstrated remarkable resilience in the face of policy uncertainty. Let's look at some key market performance highlights. The major indices posted substantial gains. The S&P 500 climbed 6.2% for its strongest month since 2023. The return in May was also the largest monthly return for the month of May since the year 1990. The Nasdaq surged 9.6% and the Dow Jones rose 3.9%. Year-to-date performance shows the S&P up 0.5%, the Dow down 0.6%, and Nasdaq down 1%. Fixed income struggled with the Bloomberg U.S. Aggregate Bond Index falling 0.7% in the month of May, though maintaining a 2.4% year-to-date gain. The 10-year Treasury concluded the month at 4.4%. Global markets participated in the rally as MSCI EAFE and MSCI EM indices each advanced 4%. Currency and commodity movements were notable. The dollar index dropped to 99.3, approaching three-year lows, while Bitcoin reached 111,000 before settling down at 104,000. Gold established new highs during the month at $3,422 an ounce, closing the month at $3,288 for a 24% increase year-to-date. Economic data showed moderation with consumer prices rising 2.3% year-over-year in April, the smallest increase since February of 2021, while employment remained robust with 177,000 jobs added and unemployment steady at 4.2%. May's performance highlighted markets' ability to recover from volatility when fundamental conditions stabilize. Following April's challenges, equity markets quickly regained their footing and moved into positive territory, demonstrating the rapid shifts in investor sentiment that have characterized recent market cycles. However, ongoing concerns about trade policies, fiscal health, and economic stability continue to create potential headwinds for future performance. The month's most significant development was Moody's decision to lower the U.S. credit rating from AAA to AA1, joining previous downgrades by Fitch and Standard & Poor's. This chart illustrates how total U.S. debt reached 122% of GDP in 2024, with net debt climbing to 97%. This downgrade reflects mounting concerns about fiscal sustainability amid growing spending obligations. Markets showed minimal reaction to the downgrade, largely because investors have already incorporated fiscal challenges into their expectations. The muted response also draws from lessons learned during the 2011 Standard & Poor's downgrade, when Treasury securities maintained their status as preferred safe haven assets despite the rating change. Diplomatic progress on trade fronts helped alleviate some investor concerns during May. New agreements with the UK and China, including a 90-day period of reduced tariffs on Chinese goods, removed several worst-case scenarios from consideration. These developments provided markets with greater clarity about the direction of trade policy. However, trade uncertainty persists as both countries have recently accused each other of violating agreements, while the administration continues pushing for higher steel and aluminum tariffs. European Union negotiations showed promise when scheduled 50% tariffs were delayed following productive discussions, suggesting diplomatic solutions remain viable even when initial positions appear incompatible. Legal challenges add another dimension to trade policy uncertainty. The U.S. Court of International Trade ruled against many newly enacted tariffs in May, though an appeals court pause allows them to remain temporary in effect. First quarter earnings provided additional market support as S&P 500 companies exceeded expectations, with 64% reporting positive revenue surprises, according to FactSet. Technology sector resilience stood out as companies navigated trade-related challenges while maintaining profit growth. Consumer sentiment showed early signs of improvement after months of pessimism related to tariff and inflation concerns. The University of Michigan's May survey indicated moderating inflation expectations and stabilizing sentiment measures. While single-month data requires cautious interpretation, these improvements align more closely with positive economic fundamentals and corporate performance trends. The bottom line, May demonstrated markets' capacity to advance despite significant policy challenges. While the credit rating downgrade highlighted fiscal concerns, trade agreement progress helped drive investor optimism. Long-term investors should focus on underlying economic trends rather than allowing short-term policy developments to derail their investment strategies.